The holiday season's frenzy of gift buying and streaming subscriptions depends on a vast unseen network of IOUs. Every swipe of a credit card, every payroll direct deposit, and every new bridge or hospital financed by a municipal bond is only possible because someone, somewhere, is willing to lend. Imagine waking up one morning to discover that confidence in debt has evaporated. Government workers are suddenly unpaid because treasury auctions fail. Mortgage rates spike so high that would-be buyers walk away from closings. The grocery store you rely on can restock shelves because their supply chain relies on credit lines that have been frozen. Before we even mention trillions or percentages, the point is that modern life runs on borrowing. If the system falters, everyone feels it. In the global debt story, there are clear factions and real stakes. On one side are governments, corporations, and households hungry for capital. They borrow to wage wars, build infrastructure, chase corporate acquisitions, and finance university degrees. On the other side are lenders, pension funds seeking safe returns, foreign governments recycling trade surpluses, and individual savers who own mutual funds. Over the past decade, those who lend have watched as developed nations doubled down on borrowing. By late 2025, total global debt reached about $345 trillion, around 310% of world economic output, with developed markets responsible for most of the $26 trillion increase that year. Emerging economies aren't innocent spectators either. They will need to refinance roughly $8 trillion of bonds and loans in 2026. Pending U.S. Supreme Court decision over the legality of tariffs could force Washington to borrow even more. The battle line is drawn between the urge to stimulate growth through spending and the discipline demanded by investors who want assurance they will be repaid. Debt markets are often depicted as abstract charts of rising lines, but the hidden engine is the global bond market itself. This sprawling marketplace of government bills, corporate notes, and household mortgages quietly circulates trillions of dollars each week. It runs on trust. Trust that the U.S. government will honor its obligations. Trust that companies will not default. And trust that currencies will hold value long enough for investors to be compensated. Central banks grease this machine by acting as buyers of last resort and by setting policy rates that determine borrowing costs. Primary dealers underwrite sovereign debt auctions. Banks package home loans into securities, and rating agencies assign grades that influence yields. Without the smooth functioning of this system, teachers might not be paid on time. Small businesses would have no operating capital, and pensioners would lose their nest eggs. Few realize that a government bond auction failing to attract buyers could ripple through grocery stores and hardware shops within days. The balance in this hidden engine has not always been so precarious. In the years following the global financial crisis, interest rates hovered near zero, making borrowing cheap and seeming to vindicate policymakers who racked up deficits to stabilize economies. Central banks hoovered up bonds, inflating their balance sheets and suppressing yields. Then came the pandemic. Governments poured billions into emergency relief. Businesses took out loans to survive lockdowns, and consumers tapped credit to furnish home offices. From 2020 to 2025, net interest payments on U.S. federal debt exploded from around $223 billion to $881 billion. Cheap money created a false sense of security. When the Federal Reserve and other central banks began raising rates in 2022 to tame inflation, the cost of servicing all this borrowing climbed rapidly. The average interest rate on U.S. federal debt more than doubled, rising from about 1.5% in early 2022 to over 3% by mid-2025. Decisions made in boardrooms and cabinet meetings years earlier were suddenly magnified. Today, the price of past choices is coming due. Global debt's share of economic output has plateaued at a historically high level, and governments are allocating ever larger portions of their budgets to interest payments. In fiscal year 2024, the United States spent nearly $880 billion on interest, more than it spent on either Medicare or national defense. The Congressional Budget Office projects that by 2026, annual interest costs will exceed $1 trillion and cumulatively total about $13.8 trillion over the following decade. Interest has become the third largest line item in the federal budget, second only to Social Security and healthcare. Meanwhile, China and other large borrowers are also issuing record amounts of new bonds, creating competition for investor funds. For emerging economies, the stakes are even more acute, with debt denominated in foreign currencies and revenues tied to volatile commodity prices. Any increase in global yields can trigger crises. Corporate debt approaching $100 trillion and household debt nearing $64 trillion add further layers of vulnerability. The future of borrowing raises unsettling questions. Can governments keep funding social programs and infrastructure while paying ever higher interest bills? Will higher yields crowd out private investment, slowing innovation? Could a crisis in one corner of the debt market, perhaps an emerging market default, or a failed treasury auction trigger a cascade through the entire financial system? Investors still have faith. For now, U.S. Treasury bonds are considered the world's safe asset, but confidence is a fickle currency. If lenders doubt that they will be repaid, they demand higher returns or refuse to roll over maturing bonds. In emerging markets, where $8 trillion of bonds come due in 2026, a sudden spike in rates could lead to defaults and social unrest. Policymakers face stark choices: cut spending and raise taxes to stabilize debt, accept higher inflation to erode debt burdens, or hope that economic growth outpaces borrowing costs. Global debt is more than a headline number. It is the lifeblood of the modern economy. It funds our paychecks, our highways, our research labs, and our streaming services. Yet it also binds future generations to promises made today. Understanding who owes whom and why is not just a task for economists, it's a civic responsibility. If you found this exploration valuable, consider supporting the channel by liking the video and subscribing for more in-depth stories about the systems and incentives that shape our lives. In our next installment, we will dive into another hidden facet of the economy and its potential to reshape our future.